this year is far more balanced in terms of this difference between supply and demand. Between April and December, fresh money coming into mutual funds has already hit an all-time record of 4.8 lakh crores. This is into risk-oriented equity schemes, balanced funds, ETFs, and so on and so forth. The amount of IPOs until December, and it's only growing even now, from an average of about 1.4, 1.5, and I'm talking about not necessarily, OFS, etc., fresh paper being issued in the market, reached a record of 2.9 lakh crores as of December itself. So both supply and demand have gone up. And it's important for us to be aware of this. Are we in the midst of a self-fulfilling prophecy where our money is coming and raising market prices and making us feel good? Or is it a much more balanced case of both supply and demand being there and therefore things being a lot more sustainable in the longer run? So this herd mentality is something that we have to keep in mind as well. And finally, the bottom line of all of this, the biggest behavioral error is being unaware of risk, being unaware of our own individual risk appetite, and being unprepared for risk. We are doing ourselves a disservice by doing this, and we are risking the ecosystem by doing that. Ultimately, for capital formation, we need risk-informed, well-informed, eyes-open investors coming in, bringing in risk money into the ecosystem. We need good issuers coming in and raising that capital, creating jobs, creating businesses, which in turn creates more savers, and then this virtuous cycle can continue. If we come in with glassy-eyed, expecting to become millionaires and billionaires overnight, and listen to and are not adequately risk-aware, we risk creating a shock where the cycle gets broken. So what is SEBI's role in all of this, in this behavioral errors that we can see? I have to hasten to add, charity begins at home. Ultimately, it is each of us as investors who have to take care of our behavioral biases. The moment we have an external focus of somebody else has to take care of my health, we are starting off in the wrong place. Having said that, we will not shirk our responsibility. I'll tell you a little bit about SEBI's approach towards making sure that these behavioral errors are addressed. First, we try and ensure there are adequate disclosures so that investors can make informed decisions. We insist, for instance, that companies that are coming out with IPOs and fresh capital raises have to disclose all their risks in a comprehensive manner and in an intelligible manner so that people can come in and know what they're getting into. Any other issuer of security or a seller of a security has to give these disclosures out. Mutual funds which are offering you schemes have to tell you where they fall on the riskometer, how risky are they. It's not a perfect measure. There are better ways of expressing risks, but at least it's a good start. However, just asking for disclosure doesn't necessarily mean that we can stop there. We've got to make sure that the quality of the disclosures is good. There are checks and balances to ensure that the disclosures are correct and comprehensive, which means a whole ecosystem of people are involved in this process, not just SEBI, and I'll come to that in a minute. Second, we've got to make sure, as part of the disclosures, that investors are aware of conflict of interest. For instance, when you deal with a mutual fund distributor, the reality is the mutual fund distributor gets a commission from the producer, from the mutual fund itself. This is completely kosher. This is the way distribution works, where distributors get paid by the producer. Now, we've got it in the code of conduct. AMFI's got it through the code of conduct that distributors have to work in the best interest of the investors.